Over the last few days, everyone has been talking about a clash of the titans. Cathie Wood versus Michael Burry, Ark Invest versus Scion Asset Management, Bull versus Bear. It's unavoidable. Two of the biggest names in investing, one who predicted and profited off the worst crash in living memory, and the other who predicted and profited off the biggest bull run in living memory. Both have their own insights, their own styles, and their own time frames, yet Cathie Wood is handicapped by having to constantly justify the decisions she makes. She runs ETFs, exchange traded funds, which allow investors to enter or exit at a moment's notice. Burry, on the other hand, runs a hedge fund. He only takes on capital from people he knows personally and who he knows fully trust him to make the correct decisions in the long run. Cathie is bound by her funds. She's forced to defend her positions when the media takes a disliking to her. First, she released a bunch of tweets which defended her funds, their performance and her style of investing, something that I've already covered. But more recently, Cathie did us all a huge favour and went on CNBC and gave a half-hour-long interview where she opened up her mind and let us know in far more detail what she thinks is going on. Now, luckily for you, I've gone through that interview, which I'm going to show you in a moment before I give you my 2 cents on the whole saga. But really quickly, if you're new to the channel, then make sure to subscribe, like and comment. We're putting out loads of content just like this constantly that you don't want to miss out on.
Hedge funds jumping ship. Investors, including Michael Burry, placing millions of put contracts against Cathie Wood's Ark Innovation ETF. The fund grew a whopping 149% in 2020. This year down just about 6%. She hit back, said Burry doesn't understand the explosive growth in innovation investing right now. Ark Invest founder and CEO Cathie Wood joins us here on Tech Chat this morning. Cathie, always good to have you. Thanks for the time.
Thank you for inviting me, Carl. Always happy to be here.
So let's talk about the short community at large. What is your message to them right now?
Well, you know what, when I see such negative sentiment out there, especially when it comes to valuation and longer time horizons, investment time horizons, I actually feel a little more comfortable. I like bad news and maybe news that's not, the discounting is worse now than the news actually will be. I actually feel better in that kind of environment for our strategies. I don't think we're in a bubble, which is what I think many bears think we are. In a bubble, and I remember the late 90s, you know, our strategy would have been cheered on, rah, 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 go get them, right? You know, and you remember the leapfrogging of analysts making estimates, one higher than the other, price targets one higher than the other. We have nothing like that right now. In fact, you see a lot of IPOs or SPACs coming out and falling to earth. We couldn't be further away from a bubble. And the reason for that is the innovation around which we have centered our research. These 5 platforms, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, are barely off the ground. The seeds for all of these platforms were planted in the 20 years that ended in the tech and telecom bust. And ended in tears, and there's a lot of muscle memory around that. But that's not what's going on right now. The seeds planted back then are beginning to flourish now, and it's just beginning with 5 platforms involving 14 different technologies, all of which are about to experience S-curves and feed one another's S-curves. I don't think the market's ready for this. That's what I meant. We've dedicated our research and investing to innovation because we think we've never been at a more provocative time for innovation in history.
So the first thing to note about what Cathie just said is that she didn't rise to the bait of the interviewer and didn't get drawn into arguing against Burry's short position in particular. I mentioned in my last video on this that I thought she came off poorly when she attacked Burry, especially considering how he hadn't mentioned her at all. This time round, I felt Cathie appeared much stronger because she focused on the positives of her fund rather than trying to fight with those who focused on the negatives. Cathie also appears to still have very strong convictions in her picks, despite the negative media attention and the poor performance of her fund over the last few months. She specifically said that she likes the bad press because it allows her fund to increase their positions in these stocks at lower prices. To be perfectly honest, this is the kind of way I expect and actually want Cathie to behave. She comes off as confident and strong, and I wouldn't be surprised if brushing off these bearish attacks on her maintain her investors' confidence far more than going on the offensive and attacking Burry did. Cathie did then go on to argue that we aren't in a bubble because in a bubble, investors are bullish, they're all predicting higher and higher price targets, and the media attention is overwhelmingly positive. Cathie argued that the performance of IPOs and SPACs, as long as a bunch of other growth stocks over the last few months and the numerous loud bearish voices that the media are pushing, disprove the idea that we're in a bubble, but to be honest, I don't really buy any of that. In my opinion, a bubble is defined by market data, not market sentiment. A bubble is defined by intrinsic values like dividend yields, PE ratios, and the Buffett indicator, not by whether or not CNBC think there is a bubble. I feel she's trying to reassure her investors, to reassure all investors, to keep sentiment high, and to make sure she isn't the star of some kind of market correction. It really shouldn't surprise any of us that she said there isn't a bubble, as to admit that there is one would lose her and her fund all credibility. She did then go on to clarify that she thinks the coming explosion of innovation in those key sectors, DNA sequencing, robotics, energy storage, AI and blockchain technology, will be so huge and so innovative that the values of these stocks now will be absolutely dwarfed by their future values. But I do wonder if she's just a little bit premature. For clarity's sake, I personally believe that decentralized finance or blockchain technology, for example, will revolutionize the way we live and change the finance sector forever. But I don't think it's going to happen within the next 5 years. It will be a slow march, fighting with regulators, governments, lobbyists and naysayers, and then all of a sudden a switch will flip and the sector will explode. I just don't think that switch is going to flip for at least another 10 years.
And I do want to get to how some of those forces are playing out on your macro thesis, which you've talked about a lot in recent months. But as far as the shorts go, in terms of how they have their eyes set on ARK specifically, is it just, do you think, is it general macro bearishness, or does it have something more to do with your ability to analyze all these companies that you're now in and stay on top of that game?
I actually think it's more of a macro call. When I read the bearish analyses, they seem to be centered on inflation and interest rates going higher, which will kill valuations. And if anything, as you mentioned, Carl, we're focused on the deflationary forces that are building up in the economy. And I think that's going to be the shocker out there, that deflation is the greater risk now, not inflation. And not all deflation is bad. There's really good deflation associated with these technologically enabled platforms. They follow learning curves, which are characterized by declining costs and prices, and enables more and more sectors to have access to these powerful new technologies. So that's good deflation. The bad deflation is going to be associated with companies who paid too much attention to short-term oriented shareholders who wanted their profits now, wanted their dividends now, and did not want companies to sacrifice short-term profitability in order to capitalize on some of these massive trends that we see building. They are going to be stuck with obsolete products, and yet in the meantime, they've leveraged up their balance sheets to buy back sales and satisfy short-term oriented shareholders. How are they going to service that debt? They're going to have to cut prices of these products and services that are not going to be as popular in the future as they have been in the past. And then the third source of deflation, which is really starting to come through now in a noticeable way, started in mid-May, when lumber prices broke. We're seeing commodity price deflation. We've gone from, lumber prices have been cut to 1/3, less than 1/3 of their peak, 1711 to 500 right now. You've got copper down roughly 15%, 15 to 20%. You now have oil down nearly 15 to 20%. And I think the cream of the crop here, and the reason this may be happening and may accelerate to the downside, is the dollar is going up. And that, of course, might be associated with what's going on in China.
Cathie, good morning. It's Deirdre. I know you've talked about commodity prices before, and I wonder if you're willing to mention any of the companies or industries that you're referring to, those that are perhaps sacrificing those long-term innovations that you're not a fan of.
Well, I think that if when we look at the S&P 500, for example, we think that because of technology changes and importantly, that a lot of industries are in harm's way. Energy certainly is. Because of electric vehicles and the move towards autonomous electric, and you can throw in autos and and the auto supply chain. They're scrambling to try and get into this new world. It's going to be very difficult. Even when you think of retail, many investors, I'm sure, think, okay, well, we've seen the destruction there. We think it's just begun in a way because online retail sales have only hit 20% of total sales here in the United States. When a trend moves from 10 through 20%, it's usually moving into overdrive. So we think a much higher percentage of sales will be online. So even retail and any business that can be done online. Financial services, I would say digital wallets, DeFi, a big problem, a big challenge for financial services.
So there we heard Cathie argue that those who are short in ARKK are doing so because they believe macroeconomic conditions are bad and that will influence her fund. And I agree entirely. I don't think Burry is bearish on innovation or technology advancing, but he is bearish on inflation and interest rates, and he probably believes that poor market conditions will be more influential than the innovation Cathie's fund sees, and that will cause a fall in price. The only problem is if Burry is correct, if inflation stays consistently high and interest rates are forced to rise, then Cathie's fund will be hit harder than the rest of the market. Finally, Cathie once again explained her belief that deflation is still a bigger threat than inflation, and that's why it drives her investment strategy. She concisely explained the 3 types of deflation that she expects to see: disruptive innovation like what Tesla has done, creative destruction like machines replacing workers, and commodity deflation like we've seen over the last few months, with lumber, oil and copper all seeing dramatic price decreases. Once again, I don't really disagree with anything that Cathie actually said there, except for her time frame. The best example of this is once again decentralized finance. I really do believe it will change the way we live, and while I am as bullish as you can get on DeFi, I also recognize that most people have never even heard of it. It will take a long time for it to take off, and once it does, it has a long uphill battle against it, where everyone you can think of will be fighting against it. Something I've seen a lot of people say about this battle between Burry and Cathie is that in the short run, Burry will win, but in the long run, Cathie will win. And I agree with this conclusion for the most part. My only consideration is that there is nothing stopping bearish investors like Burry from profiting in the short run from poor macroeconomic conditions, only to then rotate into the high growth innovative stocks that Cathie is invested in when they have dropped in value. Unfortunately, Cathie isn't able to do this as she's stuck in a pair of golden handcuffs. The market conditions are poor and the outlook for inflation and interest rates over the next few years don't look great. But she is unable to admit or even hedge against this possibility, as she has built her entire fund around innovation and technological growth, and she would lose face and investors if she suddenly changed her tune. If you're new to the channel and you enjoyed this video, then make sure to subscribe. If you want to help spread the word, then consider liking the video and leaving a comment, and YouTube will do its part and push this video out to more people just like you. There are also links down below in the description where you can get a guaranteed $25 from crypto.com, up to $250 in free Bitcoin from BlockFi, and up to $2,300 in free stocks from Webull. There's also a link to the brokerage that I use most of the time called eToro that you can check out if you want. Thanks for watching. Until next time.